Okay, we are back with Jeremy Kronick. He is with the Howe Institute. He's Associate Vice President at that organization. We are talking about the Bank of Canada and its 50 basis point rate cut. Jeremy, thank you again for being here. We began our first conversation by talking about the neutral rate, the rate at which the overnight rate of the Bank of Canada is neither stimulating nor restraining the economy. What about the terminal rate, which is where the Bank of Canada ultimately is going? Where do you think we're going here?
Yeah, I was in the camp that I thought they'd be at the higher end of that neutral rate range when when they started loosening monetary policy. But I see a fair amount of weakness here, and I think there might be a little bit more to go. And so I wouldn't be surprised if they ended up closer to the 2.25, 2.5 range. Now, there's a difference between kind of the neutral rate in the shorter term and where the neutral rate, if you look really far ahead, is. But I think in that shorter term, I could see it being closer to that 2.25, 2.5 range.
Let's talk about housing. One of our economist guests today made the point that the Canadian housing market, which has been a real driver of growth in recent years past in the Canadian economy, no longer playing that role, and very much affected, of course, by things like changes to the rates.
Yeah, so it's going to be interesting. OSFI changed some rules around the stress test and when you change lenders, and that could actually provide a little bit of a boost in the housing market. Obviously, lower rates, like I mentioned in the last segment, will affect the variable rate, but it'll also affect, to some extent, the fixed rate. And I still believe there's a big chunk of people who in 2025 are going to face vastly different conditions, even with lower rates, than they did in 2020. Because the 5-year fixed rate's the most popular. A lot of people took out in 2020 when rates were at the low end. Even below 2%, you could get a 5-year fixed. And so you're going to be facing a higher rate today, even with these cuts. So the housing market is going to play a very interesting role here. The
bank must talk about that in its deliberations. It doesn't acknowledge so publicly. But what do you think the bank thinks about this mortgage reset situation, which is still a fairly significant risk?
Yeah, I think they've done a lot of work around this, a lot of sort of estimating, how these different chunks of people and when they go to renew and what that might mean. I think the challenge is knowing really how much people truly have adjusted lifestyle in order to prepare for it when it happens, right? Like, you can put all the numbers in on how much people have saved and how much they've consumed or invested, but that sort of monthly budget that people have, how much have they really prepared for what is a big difference from where they were in 2020?
Okay, let's shift to south of the border. I asked this to my economist guests this morning as well. The U.S. economy is slowing. The Fed, of course, is cutting rates in response, but it's slowing. It's much more robust than the Canadian economy is, and other developed market economies as well. Is that a cushion to us here in Canada?
Yeah, I think to some extent it is. And there's some interesting numbers in the U.S. on business formation. And that actually has continued to increase, which is typically a good sign for an economy. And if the U.S. economy is strong, given how much we export to them, that'll make us strong. And the dollar might depreciate here, which will make imports and traveling more expensive for Canadians, but it'll make goods cheaper for purchase from the U.S. So what happens there certainly is going to impact us and act potentially as a cushion.
And we're in the midst, not in the midst, we're in the final stages now of the U.S. election campaign. We're a couple of weeks away. One of the candidates, Donald Trump, is promising to dial up tariffs. There's a very pointed editorial in the Wall Street Journal today in which the Wall Street Journal's editorial board really attacks the notion of Trump and his tariff plans, arguing it would be terrible for the U.S. economy, not the Canadian economy, the U.S. economy, and effectively raise prices not only for consumers but for companies in the U.S. as well. Let's talk about that issue and then what it could mean for Canada.
Well, we mentioned the cushion in the previous question, but this is the opposite of that, right? This is really this could be a dangerous thing. Like you said, it impacts the prices of goods for Americans, and then potentially slows down their economy, and then it also potentially slows down our economy because it makes our exports more expensive for Americans. So those are sort of two competing issues on the U.S. front. On the one hand, their economy, despite some softening, still is pretty strong, certainly stronger than we would have thought given the rate hikes they put in place. But the impact of those tariffs, we'll see what happens if Donald Trump gets in, but. Nevertheless, like those tariffs, if they do come into play, are gonna play a big role.
Jeremy, thanks a great deal for your insight today.
Thanks for having me.
That's Jeremy Kronick.